In February, the appetite for risk was supportive for equities, which rebounded above 5% in both Europe and the US. European equities continued to outperform US equities on the back of the ECB quantitative easing program, which was announced in January, and on the back as well of supportive economic data released for Europe mid-February, which continued to support the appetite for European assets. In fixed income markets, bond yields rebounded and rose by 35 basis points in the US, while they remained flat in Europe. German bond yields are at historical low levels at present. As a result of the spread widening between US yields and European yields, the US dollar continued to appreciate, albeit at a slower level than over the recent months. In this environment, hedge funds continued to provide solid returns. The Lyxor hedge fund index is up 0.8% in February and above 2% year to date. Almost 80% of the funds on the platform are in positive territory year to date. The strategy that outperformed in February was event-driven. The strategy benefited from the positive risk sentiment from exposures to energy and financials and to specific deal developments as a result of additional merger announcements in the healthcare sector and the spread tightening over several deals on which they are exposed. On a negative note, CTAs were flat in February. They were exposed to trend reversals in the fixed income and energy markets. They remain nonetheless adequately exposed on equities and foreign exchange. Going forward, the key event in March to monitor will be the Fed meeting on 18 and 19 March. Janet Yellen is expected to drop the patient word in her wording, and as a result, markets could be a little bit more volatile, although we continue to believe that the second quarter should be positive for risk assets. On the alternative space, we think that global macro is the strategy to play the catch-up of the euro area compared to the US. Global macro managers have a preference for European equities versus US equities and should thus benefit from the QE in Europe and from the positive surprises in the region. We also like event-driven in this positive risk sentiment environment. Event-driven is a strategy that should continue to recover as a result of additional deal spread tightening and deal announcement in the US in particular. For CTAs, we are somewhat less positive going forward, but we still have a strong preference for short-term CTAs versus long-term CTAs. The latter could be exposed to additional trend reversals in the fixed income and energy markets.